Hey, I'm Chris Parrish, Chief Investment Officer at Oak Harvest Financial Group here in Houston, Texas, and it's a new year. First off, the team here at Oak Harvest appreciates your support, and we appreciate you tuning in to our YouTube retirement planning videos, as well as our weekly investment News or Noise, and keeping you connected to your money podcasts. If you like our content, we would welcome you referring our channels to your friends and family. Since early November of last year, the investment team here at Oak Harvest has been messaging that the first half of 2022 would not be like 2021. We've stated almost weekly that investors should expect actual realized volatility to rise, and regardless of whether Santa came to town during the second half of December, expectations for 2022, particularly in the first half, should be greatly tempered. We released our first half 2022 outlook on December 3rd under the title, Curb Your Enthusiasm, Yields to a Bull Market Buy. It can be found on our website at oakharvestfg.com or in video format on our YouTube channel. Check it out, and we hope you become a YouTube subscriber to our content. Sure enough, the first few weeks of 2022 have started out with a bang, and that's not a New Year's Eve champagne cork bang in a good way. For those of you hoping for a continuation of 2021's calm market pattern, well, you're already having to face the reality of 2022. It won't be as easy this year. So I wanted to go back and to readdress a topic we've discussed many times in the past. That topic, market volatility. And I wanted to go a little deeper into how our team looks at this factor versus the everyday commentary you might hear on TV. And I wanted to discuss how we might use it in determining whether we go fast or slow in making incremental investment decisions for our clients. Let's call this episode Market Volatility Advanced Training. First off, viewers remember that spot volatility indexes, quoted most often on TV, that's the VIX index for the S&P 500 and the VXN index for the NASDAQ 100, are not tradable. They're both math calculations that reflect a market estimate, and the key word there is estimate of future 30-day volatility. I repeat, these often quoted indexes are not directly tradable. They are just math numbers based on short-term implied options premium in the S&P 500 or the NASDAQ 100. Because of this, the spot VIX by itself has little to no predictive ability in forecasting markets. However, there are volatility instruments and tradable tools that, when combined with the level of the spot VIX, have been pretty good at helping forecast short of a black swan event when and about how much risk is in the overall markets. Here is a graph of the volatility term structure of the overall S&P for the next 9 months, taken on January 4th of this year. Here it is right here. As you will see, that structure on that day was an upward sloping curve. That is, it's up and to the right. Up and to the right. It's the same shape and pattern that most financial futures markets have. Things like interest rates or other things that are shaped like this are normally in this pattern. Why? Because insurance costs more the farther out in the future you go. This is called time premium. Why does this additional cost grow larger the farther out in time you go? Well, that's because more uncertain things can happen the farther out in the future we look. More floods, more car wrecks, more accidents, both big and small. Spot volatility, which I remind viewers is not tradable, was about 17 when we started the year. This is while the actual cost of insuring against future volatility out 5 months into May was about 25. Way up here. You can actually buy and sell this. This is where liquid markets come from. It is not just a math equation like the spot VIX. Without getting too much into the weeds, here are 3 things we look at when our team speaks about volatility and helping with setting our forecasts. 1, since the farther out monthly volatility futures are freely tradable on the CBOE exchange, they have real price discovery in them. Price discovery is important in that these future prices are actual trades and transactions versus the spot VIX index, which is just a math formula. Think of this as the difference between, say, the quote you get from your real estate broker when you're looking at listing your house for sale, that would be the spot index in this analogy, versus the actual final selling price that you might get months out in the future when your house sells and the bank transfers the money. That would be the forward futures market. The first quote on your house is the best guess based on comps. And the second is an actual transaction price. And we all know that a lot of things and changes can happen between the real estate agent's initial opinion and the final sales price out months in the future. Because these futures contracts on volatility are real transactions, we can look at the longer-term daily and weekly price charting trends on them and determine real supply and demand. We look for trends in extremes and resistance levels in forward volatility futures markets to estimate supply and demand for these contracts. These pictures and charts can give us a great deal of information at what level future market anxiety and worries lie. The other two measurements we like to track with regards to volatility is one, the absolute spread or difference between spot index value and real pricing in future months, and two, the percent premium or discount that spot volatility is into future price volatility. Without getting into the minutia, with these measures and tools, we're able to detect that the market reached short-term panic levels in very early December of last year when the Omicron COVID variant was first discovered in South Africa. Viewers, recall, back then the S&P 500 sold off to around 4,500, and the talk throughout much of the financial media was that the worst, the markets would crash again like it did in March of 2020, or at least the December Santa Claus rally wouldn't happen and the markets would end the year poorly. Well, viewers, what happened to the S&P 500 in December? Exactly opposite those emotionally driven calls. This volatility model said relax, breathe deep. Neither of these negative forecasts were likely short-term outcomes. And what happened in December? The S&P 500 closed the month up over 4% and ended the year near 4,800. Likewise, we can add and do use this tool to aid us on an early warning indicator. Sometimes this type of indicator can help us warn that investors are being too complacent and not fearful enough short term. Such was the case a couple of times in 2021. It gave that reading once in mid-first quarter and then again in mid-summer. What is this indicator saying currently? It's saying the same thing it started to say in early November of last year. It's making the case to be patient and go slow throughout the first few quarters of 2022. It's saying, unlike most of 2021, that there will be plenty of buying opportunities, market rotations, and fits and starts because of higher realized volatility throughout the first half of 2022. We can blame the Federal Reserve, we can blame a COVID slowdown, or we can blame inflation concerns. The insurance indicator doesn't care. It just prices volatility. However, viewers, the good news is that right now, and yes, this can change down the road, and no, it's not only thing that matters, but right now, the indicator is saying that by late summer, in front of the midterm 2022 elections, and against the likely backdrop of a slower economy, the sun should shine again on the overall market. Our first half concerns should pass, and we should exit 2022 on a high note of optimism for the economy and highs in the market. Is this a perfect indicator? No, not a chance. Nothing is. Black swans can hit at any time. That's important to remember. However, this is a valuable tool that we use in our analysis and we will continue to use and watch as we take on the first half of 2022 in the markets for our clients. From the whole team here at Oak Harvest, thank you for your support and your trust throughout 2021, and we hope we can continue to be your partner and provide you with value-added service in 2022. And viewers, please feel free to give us a call here in Houston to speak to one of our advisors. Let us help you craft a financial plan that meets your retirement goals and needs first and your greed second. Give us a call here at 877-896-0040. We're here to help you on your financial journey into and through your retirement years. I'm Chris Paris, CIO at Oak Harvest, and have a great weekend.